We've been saying for a week or two now that we feel that maybe equity markets in the short term might be getting a bit ahead of themselves. The road to recovery is unlikely to be smooth, both in terms of the speed of opening up and whether we see any re-acceleration of COVID-19 cases as that happens, and people just testing the environment, see how far they can push it, and maybe pushing it a little too far. Probably the US is at the most at risk of doing that at the moment, but everybody's at risk in reality. So markets, you mentioned earlier, is a technical bounce from very oversold levels. So we've seen about a 50% retracement of those losses now. We think we're probably going to go for a period of weakness before the longer-term rally resumes.
Okay, fair enough. But you're still betting on global equities and multi-asset income strategies, which is essentially you're chasing dividends in this market, and you think that's a more prudent strategy than going in for bonds and increasing cash levels. So risk is coming back, albeit slowly, but steadily in the markets, you think?
Yeah, so on a 9 to 12 month basis, we're still constructive on the outlook. So we do see us getting through this environment. Obviously, it is going to be an extremely bad recession, but we do believe it's going to be largely short-lived, with a recovery starting in the second half of the year. And that should encourage people, together with monetary and fiscal stimulus of unprecedented, that word again, unprecedented levels that we've seen in the past 4 to 6 weeks. That should help people then start looking at, in a world where there's very little alternatives, for people to add risk to their portfolios. I mean, you look at the 10-year Treasury yield. We're talking a year ago about how 10-year Treasury yield, the TINA factor, there's no alternative, had disappeared. Well, it's back again. The Treasury yield has fallen by 50% since March. Again, people are being pushed back into risk assets. So once the recovery comes through, then we think risk assets generally will do well.